One of my main questions is how can my real estate business or starting a real estate business offset my taxes in my W-2? Say you bought a property in a different state, like Oregon. Do those taxes fall back on where the business, does it come based off of Oregon or does it fall back to like your business base? What are some common business write-offs that you can use when you're starting off?
So welcome to Office Hours by Fujikawa Associates. And today we are not in the office, but we are out of the office and we are going to interview Gabby, who is an aspiring real estate investor. And she's going to ask all of the what happens when I buy a rental property questions. And I think the fun thing is she's also really into racing.
Yes, that was really cool.
So is there a way that you can race and how could you maybe write off some of those expenses as well? That's all coming up next.
Well, it has to be a business.
Okay.
So yeah, you can't just take all of your expenses and just try and write them off against your W-2 income.
Okay.
So you have to, what the IRS says with businesses, you have to have a profit motive. So even if you have losses in the first couple of years, they kind of expect that with new businesses, but you do have to have a goal of making money.
Right.
But the burden of proof is on you. So you're gonna have to show that you have a business plan, that you have, everything in a row, that you're running it like a business.
Mm-hmm.
If you're just kind of spending money on things and just hoping that, you make money, that won't work. And then the IRS could deem it a hobby. And then that's kind of the worst of all worlds because you have to report all your income and you most likely won't be able to deduct any of your expenses.
Okay.
So you have to be careful with that, yeah.
If I used it as like a marketing, because you know how people will in racing, like you put logos on cars, motorcycles and everything like that. So if I can just prove that I'm getting business or generating some kind of like networking connections through that, would that count?
Yes, but you do have to document it. So, just putting your name on something doesn't necessarily make it an advertising expense.
Right.
I mean, like a funny story, like clients will buy like these like super nice cars, like, $150,000 cars, and just put their logo, a little logo on it and try and deduct it as advertising.
It doesn't work.
It doesn't necessarily work. I mean, it can technically, but it doesn't necessarily work. You really have to show that it's that it's an actual advertising expense. So like, if you're racing and you put your logo on and you're paying to, put that logo on, say your bike or whatever it is.
Okay.
You have to show that that's actually bringing in customers and you're actually doing networking at these events and things like that for that particular business to make it a valid deduction.
Okay. Yeah, a lot of people at these events have booths. So say one day I have like a booth and I put the logos on the bikes and everything like that, and people come up to my booth and they're like, hey, I want to know about what you're doing and say, I want to buy a property off for you, or I want to get into what you're doing, like something like that.
That would definitely
makes it more valid.
Yeah, yes.
Okay, that makes sense. Sweet. So I got to get a booth.
Yeah, that'd help.
Okay.
You don't have to, but that'll definitely help.
Right,
Yeah.
okay.
So, well, I guess we're talking about two different things, right? So the real estate side, if you're advertising that, then you can, like having that booth and things like that would help you make that advertising deduction on the real estate side. But on the racing side, if you're trying to make that a business and actually trying to make money on that, then yes, like your question, yes. If you have the more of a business that you make it, the more that you can prove that you have a profit motive.
Okay.
So if you're just racing with hopes of trying to win a race or make money off of races, and that's just kind of a hope that you have. That's not really a business
Sounds
plan.
like a dream.
But if you're you're creating a brand, you're marketing that brand, you're selling merchandise like Josh said and things like that, and really making it into an actual business, then that makes it more legitimate in the eyes of the IRS.
Okay. That would be if I turn motorcycles and racing into a business.
Yes, yeah.
Selling merch just related to that. That's when it would work. But if I want to...
It would help your overall situation, yes. And not necessarily make it work, but it would help your overall situation.
You can hope. Yes,
yeah.
I work at W-2. I'm a pediatric trauma nurse. Sure. I want to start getting into the real estate business. I've done some research, and one of my main questions is how can my real estate business or starting a real estate business offset my taxes in my W-2?
Yeah, there's a lot of things. Real estate is a great vehicle for that.
Okay.
But it's not like a normal business where you may be able to deduct all of your expenses against your W-2 income unless you meet certain qualifications.
Okay.
So just having a rental property, like say you just get a long-term rental property rented out to tenants on a yearly basis.
Right.
That probably, depending on your total income, it probably wouldn't you wouldn't be able to deduct that against any losses against your W-2 income.
Okay.
But there's other avenues. the two main ones are real estate professional, and then there's something called like a short-term rental loophole. Real estate professional would be hard if you're a full-time W-2 employee, because you have to spend at least 750 hours in real estate, and it has to be more than half your time. So if you're working a full-time job plus overtime, it'd be hard to work more in real estate than in your regular job.
Right. So go ahead.
Oh, no, go ahead.
Full-time saying 40 hours? Because, I mean, I'm a nurse. My minimum requirement is 24 hours a week, and that's considered full-time at my job.
It's just however many hours. So if you worked 1,000 hours at your regular day job, then you need 1,001 hours in real estate in order to qualify for this real estate professional status.
Gotcha.
So there's other requirements, but that's the big hurdle that you have to cross in order to reach it. Yeah.
So from what I'm understanding, it like the IRS is going to look at it like a hobby almost. Like they're not going to look at it as like a job yet.
Yeah. So real estate, it's called, the IRS identifies it as what's called a passive activity. And so passive income or passive losses can't offset your regular ordinary business or W-2 income.
Gotcha.
And so if you have losses in real estate and it's a passive activity, then it's just kind of, it's a separate thing that you don't lose them, but they carry over until certain events are hit.
Okay.
And so, but the real estate professional turns it into active income. So it's actually like your job.
Right.
So then if it creates losses, you can offset that against your W-2 income.
Okay.
So it works well. A lot of times it works well when you're married, right? When one spouse doesn't work and one does. If you have a high W-2 income for one spouse, the other one can become a real estate professional and offset the W-2 income from their spouse by creating losses in real estate.
Okay.
Yeah.
Interesting. So what are some common business write-offs that you can use when you're starting off?
So you're going to have a lot of legal fees. Those are going to be some of your startup costs.
Okay.
Filing fees, things like that. So those are the most common ones, like right when you're starting off. And they'll probably have a lot of advertising as you're getting going and building up for a business. Real estate, maybe not so much advertising, but real estate might be more education and networking and things like that.
Okay.
But those are kind of the big things when you're starting up. And then as you get going, you'll have more of your day-to-day business expenses.
So this might be a very technical question.
Sure.
I understand that some people, when they start a business, they put like the business address in another state for tax benefits. So say you were to have your business is based like in a state, I don't know, a separate state. Let's call it Nevada.
Yeah.
Because I know California is pretty nitty gritty and expensive. And say you bought a property in a different state, like Oregon. Do those taxes fall back on where the business, like say you put that property under your business, all the taxes that you have to like deal with for that property, does it come based off of Oregon or does it fall back to like your business base?
Depends on how you structure it, but California is they like to pull things in as much as they can. So the thing is, if you're, like, say, the only shareholder or member of an LLC or business that's located out of state, and you reside in California, then the IRS, even if that business is out of state, the IRS deems that as doing business in California.
Interesting.
And will pull that income in.
Okay.
So even though you created the business out of state, it very likely would still be taxed by California unless you move to that state, out of California and move to that state.
What if you have like a P.O. box address? Is that a common thing?
It is, but they'll look at the shareholder and they'll look where you reside. So there's plenty of public record to show, if you're in California, even if you're using a P.O. box on the tax return.
Right.
For residency, they've gone as far as even looking at where if you get audited, they'll look at where you do your grocery shopping.
Wow.
So, look at your credit card statements and say, hey, you went to a grocery store in, California, 90% of the time. So,
Interesting.
You're actually
I didn't know that.
there. So yeah.
Okay.
They're very aggressive in pulling income back into California.
Makes total sense.
Yeah.
Because I feel like a lot of people do that for those benefits, but
Yes.
I feel like, they're going to catch on. The government will catch on. So.
Yeah.
Okay, good to know.
I would probably look out of state like you are, just because California is so inflated. I mean, not necessarily overinflated, but it's just so expensive right here.
Right.
My wife and I, we do mostly midterm rentals.
Okay.
So we look into that. It does take more time. It's probably closer to the short-term rental end of the spectrum than it is a long-term rental, but But we found that we've gotten, better returns in that area.
Okay.
But yeah, definitely out of state. We're starting to look at more long-term stuff out of state, just because it would be harder for us to kind of manage something out of state than it would be close by. We do have a couple here in California in the Central Valley, so it's a little less expensive, but not. I wouldn't say totally affordable. Certain areas are, but then you're not in the greatest areas, right?
Right.
So I guess, I don't know, that's kind of what we would look at if we had kind of that nest egg to start out with.
Right. Okay.
Yeah.
So where does the majority of the money go when, let's say you have like a lump sum of money, like where do you see that money usually go when you're...
The vast majority will go to your down payment.
Okay.
Right. So you're going to need that for whatever. So, $200,000 home is going to need a $40,000 down payment if you're going to put 20% down.
Okay.
So most of that's going to go there. And then some of it might be, educating yourself in the area, doing things, maybe taking trips out to areas that you want to go to look at and see different properties.
Okay.
You just have to be careful, because if you go to too many different places, if you don't buy in those areas, those won't be deductible. So
right, looks like you're just vacationing.
Yeah. So even if you are looking at properties, right, though, it's not necessarily, it can count for those 750 hours of real estate time, but it doesn't count towards that one particular property. So you won't be able to deduct the expenses unless you actually end up purchasing a property in that area.
Interesting.
Yeah.
Okay. How do you manage those properties out of state? Do you just hire like property managers?
Most people do. I know some people that manage it themselves. They just have people out there that do stuff for them.
Okay.
We used to manage our California properties ourselves. For short term or midterm, it's a lot of work just because the turnovers and everything.
Okay.
Long term, probably not so much, but we've recently just had someone start managing them for us. I mean, you pay for it; it's expensive, but it takes a lot of the huge load off of you. So
I can agree. Yeah.
It's been helpful. Okay. Well, Gabby, if you have any follow-up questions, feel free to reach out to me anytime.
I will. Thank you so much.
You're welcome.
Well, if you found value in that episode, please make sure to like and share this with someone else who you think may have these questions. And of course, if you want to connect with Derek, where can they find you?
You can always email me or find me on Instagram at DT Fujikawa.
Awesome. And that's all going to be linked down below in the description. And so we will see you there. Thanks, Derek.
Thank you.